Picture turning $5,000 into a staggering $1 million in just 2 short years. Sounds unbelievable, right? But with the right investment method, it can be your reality. This incredible financial journey is made possible by a unique strategy developed by William O'Neill, the author of How to Make Money in Stocks, a Winning System in Good Times or Bad. This isn't just a book, it's a roadmap to financial freedom, divided into 2 essential parts. The first part uncovers the secrets of the CANSLIM investment rule, a revolutionary approach to investing. The second part delves into avoiding losses, a crucial aspect of any investment journey. So, are you ready to uncover the secrets of the CANSLIM investment rule? C stands for current quarterly earnings, the bedrock of any successful investment strategy. Let's delve into the world of current quarterly earnings. Picture these as the financial heartbeat of a company, pulsating with the rhythm of success or faltering with the irregularity of failure. It's the financial pulse we check before investing, providing the data to make an informed decision. Take, for instance, a company with steady and robust earnings. These strong earnings are a testament to the company's sound management and effective business strategy. It's the kind of company that's not just surviving but thriving, navigating the choppy waters of the business world with aplomb. It's the kind of company that's primed for growth, with a stock price poised on the brink of a steep incline. Now let's flip the script. Consider a company with weak earnings, a company that's struggling to meet its targets, a company whose financial heartbeat is more of a faint murmur than a steady beat. This is a company that's in trouble. It's a company whose stock price is likely to take a nosedive, pulling down your portfolio with it. You see, strong current quarterly earnings are a sign of a company in good health. They're a sign that a company is doing well and that its stock price is likely to rise. Weak earnings, on the other hand, are a warning sign, a red flag that signals potential trouble ahead. When it comes to investing, knowledge is power. Understanding a company's current quarterly earnings gives you the power to make informed investment decisions, to choose the winners and avoid the losers. So when you're evaluating a potential investment, don't just look at the company's past performance or future potential. Look at its current quarterly earnings. Check the company's financial pulse. Is it strong and steady, or is it weak and irregular? The takeaway is simple. Always invest in companies with strong current quarterly earnings. A represents annual earnings growth. It's not just about the present, it's about consistent growth. This is the second pillar of the CANSLIM investment strategy. But why is it so crucial? Well, think about it. When you invest in a company, you're essentially buying a portion of its future earnings. If a company's earnings are steadily growing year after year, it's a strong signal that the business is thriving and its future prospects are bright. Take, for instance, the tech giant Apple. Back in the early 2000s, Apple was just another tech company. But then, they introduced the iPod, followed by the iPhone, and their annual earnings started to soar. Investors who recognized this consistent growth early on and invested in Apple have seen their investments grow exponentially. But consistent annual earnings growth isn't just about spotting the next tech giant. It applies to all sectors. Whether it's a retailer expanding its store footprint, a pharmaceutical company launching a breakthrough drug, or a utility company gaining more customers, consistent earnings growth is a positive sign. Now, it's important to note that we're not just looking for any growth, we're looking for significant above-average growth. A company that's growing its earnings by 20%, 30% or more each year is a company that's likely outperforming its competitors, capturing market share, and building a strong, sustainable business. But how do you find these high-growth companies? Well, that's where financial reports and earnings statements come in. By reviewing these documents, you can track a company's earnings growth over time and identify those businesses that are consistently delivering high growth. Remember though, investing is not about chasing the highest growth at all costs. It's about balancing growth with other factors like the company's financial health, industry trends, and market conditions. That's why it's just one part of the CANSLIM strategy. Remember, consistency in annual earnings growth is a key factor in successful investing. If you can master this, you'll be well on your way to building a profitable investment portfolio. N stands for new. New products, new management, new highs. Newness is a catalyst for growth. Let's delve into the power of new in the world of investing. Newness can be a potent force in driving stock prices. When a company launches a new product, it often leads to a burst of growth and consequently a surge in the company's stock price. Think about it as the excitement of unwrapping a gift, the anticipation, the curiosity, the potential. It all adds up to create a buzz that can significantly impact a company's performance in the market. Let's look at some examples. Consider Apple. When they launched their first iPhone in 2007, it was a revolutionary product. The market reacted with enthusiasm, and Apple's stock soared. The introduction of this new product not only changed the face of personal technology, but also immensely boosted Apple's market value. But new products aren't the only new that can stir growth. New management can also be a game changer. When a company brings in fresh leadership, it often signals a shift in strategy or direction. This change can reinvigorate a stagnant company or lead an already successful company to new heights. Let's take Microsoft as an example. When Satya Nadella took over as CEO in 2014, he steered the tech giant towards cloud computing, a move that has since paid off handsomely. Microsoft's stock has more than quadrupled under Nadella's leadership. Finally, new highs in stock prices can also be a positive sign. When a stock is reaching new heights, it means the market is recognizing the company's value and potential. It's like a snowball effect. As more and more investors see the stock's success, they want in, which drives the price even higher. So the power of new in CANSLIM cannot be underestimated. Whether it's a new product, new management, or new highs, these elements can significantly impact a company's stock price and your potential returns. Always keep an eye out for the new. It's often the spark that ignites growth. S for supply and demand, L for leader or laggard, I for institutional sponsorship, and M for market direction. These four elements complete the CANSLIM strategy. Let's start with S, supply and demand. It's simple economics. When supply exceeds demand, prices fall. When demand exceeds supply, prices rise. In the stock market, this translates to the number of shares available versus the number of shares investors want to buy. A company issuing new shares, for instance, increases supply and can dilute the value of existing shares. Conversely, a company buying back shares decreases supply and can increase the value of remaining shares. This is how supply and demand plays a vital role in the stock market. Moving on to L, leader or laggard. It's all about comparing a company to its peers. Is the company a leader in its industry, consistently outperforming others? Or is it a laggard, falling behind the pack? Investors should focus on industry leaders as they often offer the most reliable and substantial growth opportunities. Next, we have I, institutional sponsorship. Institutions such as mutual funds, banks, and pension funds buy large quantities of shares. When these big players support a company, it's often a positive sign. Their buying can drive up share prices. However, be aware, it's not just about whether institutions are buying, but also who is buying. Not all institutions are created equal. Some have better track records than others, so it's important to consider the quality of the institutional sponsorship. Lastly, M, market direction. Despite all your research and analysis, it's crucial to remember that the overall direction of the market can significantly impact your investment. Even the best of stocks can struggle in a down market. On the other hand, in a bull market, even laggard stocks can rise. It's essential to consider the overall market trend before investing. Each of these elements, supply and demand, leader or laggard, institutional sponsorship, and market direction, play a crucial part in the CANSLIM strategy. Used together, they form a comprehensive approach to investing. This strategy doesn't just hint at which stocks to buy and when, but also advises on when to sell, helping to maximize gains and minimize losses. Remember, investing is not just about buying stocks and hoping for the best. It's about understanding and analyzing the market, the industry, and the company. It's about making informed decisions based on proven strategies. So there you have it. The complete CANSLIM strategy, a proven method to turn thousands into millions. Now that you know how to make money, let's discuss how to avoid losing it. First up, we'll tackle cutting losses short. William O'Neill suggests that you should never let a loss exceed 7 to 8% of your initial investment. Sounds simple, right? But it's often easier said than done. The key here is discipline. It's crucial to stick to your predetermined selling point, no matter how confident you feel about the stock's potential turnaround. Keep in mind that it's better to exit a trade with a small loss than to risk a larger portion of your capital. The second strategy focuses on avoiding margins. Simply put, buying on margin is like borrowing money from your broker to purchase more shares. While this approach can amplify your profits, it can also magnify your losses. So, as a rule of thumb, O'Neill advises against buying on margins, especially if you are a novice investor. It's always safer to play with the money you actually have. Moving on to the third point, being wary of hot tips. We all have that friend or colleague who swears by their stock tips. But as O'Neill points out, these hot tips rarely pan out. It's important to conduct your own research and due diligence. Remember, investing should never be a game of following the herd. It's about making informed decisions based on research and analysis. Next up, we have not averaging down. This is the practice of buying more of a stock as its price drops, in order to decrease the average cost of your shares. It may sound like a good idea in theory, but in reality it's a risky strategy. O'Neill suggests that it's better to average up, buying more of a stock as it rises and proves its worth. Last, but certainly not least, avoiding illiquid stocks. Illiquid stocks are those with low trading volumes, making them difficult to buy or sell without impacting the stock price. These stocks often exhibit higher price volatility and can be risky to hold. O'Neill advises focusing on stocks with high liquidity to ensure you can enter and exit trades easily without significantly affecting the market price. So there you have it, 5 essential strategies to avoid losses in the stock market. These tips aren't just about preventing monetary loss, they're also about cultivating a disciplined, informed, and strategic approach to investing. Remember, the stock market isn't a casino. It's a platform for businesses to raise capital and for investors to become part owners of those businesses. Avoiding losses is just as important as making profits. Remember these 5 tactics to safeguard your investments. Let's recap the power of the CANSLIM method and the importance of avoiding losses. We've discovered that the CANSLIM method, a brainchild of William O'Neill, isn't just a catchy acronym. It's a potent tool for investors to navigate the ever-changing waters of the stock market. By focusing on current quarterly earnings, annual earnings growth, new products or services, supply and demand, leader or laggard, institutional sponsorship, and market direction, you're not just investing. You're investing wisely. We've also learned that avoiding losses is as crucial as making profits. It's about knowing when to hold them, when to fold them, and most importantly, when to walk away. The right knowledge and a bit of courage can turn a modest $5,000 into a staggering $1 million in just 2 years. Invest wisely and remember, the difference between $5,000 and $1 million could be your understanding of the CANSLIM method. Don't forget to like, subscribe, and share our channel with your friends. Stay tuned for more investment strategies.